The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everyone. Welcome to the AVPN November webinar on fostering innovation and creating impact via sustainable and responsible investments. My name is Dorothy, and I'm the Membership Services Manager at the Asian Venture Philanthropy Network. AVPN is a unique funders network committed to building a high-impact philanthropy and social investment community across Asia. Currently, we have over 390 members across 29 countries, and we are very privileged to have two of our members based in the UK speaking today. Representing Schroders, we have Kate Rogers, Head of Policy. She will share with us how philanthropic investors can align their mission and aims with their investment policy, why this is important, as well as how sustainability is achieved at Schroders. Following that, we have Fabrice Bienfait, a partner at ETF Partners. Fabrice will walk us through how sustainability can be achieved through innovation. He will share some examples and case studies with us that will demonstrate how technological innovation can answer some of the world's most pressing challenges. Before we proceed, a few housekeeping instructions. We will not take any questions during the presentation, but will open up the floor for Q&A afterwards. Please feel free to use the console to type in your questions during the webinar, and I will raise the questions to our speakers. If you have further questions that are not answered by the end of the webinar, you can email us at membership@avpn.asia. Without further ado, I will now hand over the time to Kate Rogers.
Right, good afternoon, everybody. I'm absolutely delighted to be here talking to you about investing sustainably. And I'm looking at it from the viewpoint of philanthropic investors who not only have a financial motive, but a social purpose as well. In this session, what I want to cover is firstly some brief definitions. There are lots of words to describe responsible or ethical or sustainable investment approaches. So what I'm going to try and do is draw a map to explain how I would describe the responsible investing landscape. I also want to cover the options that are available for philanthropic investors who wish to connect their investment strategy with their charitable purpose, just illustrating how it's done in practice using some of my own research from the UK that was published by the Association of Charitable Foundations. I also want to cover what investment managers could do to help philanthropic investors make an impact and why it's important. I want to show you that you can make a positive impact with your investments by working in collaboration with investment experts who value both the financial returns and sustainability, in the belief that sustainable companies will deliver the best financial and social returns over the long term. So who am I? Well, my job is to look after the long-term investment assets of charities and foundations. I'm based in London, as Dorothy said, where we're the largest asset manager of UK philanthropic and charitable organisations. But I also have the privilege of working with colleagues globally, including our Singapore and Hong Kong offices. We work with over 1,000 philanthropic organisations with $16 billion of assets under management. So the majority of these charities and foundations are investing across lots of different asset classes with a focus on maintaining the value of their assets ahead of their local inflation rate, whilst also generating any excess returns to spend on their charitable purposes. Most have the bulk of their assets in public equity and bond markets, so just normal equities and bonds, so that they benefit from the liquidity that these markets offer. But increasingly, we're seeing these philanthropic investors wanting not just their spending to do good, but their whole asset base. What an amazing opportunity to use all of your assets to further your cause, getting more bang for your buck. So with that background, let's look at some definitions. Sustainability in investments can be mapped onto a spectrum. On the left, hopefully you can see the slide, approaches that are consistent with investors wishing to take a finance-first approach. So that's where they're prioritizing financial return. On the right, approaches that are prioritizing social return. At this extreme is philanthropy, giving away your money. That's 100% social return. Obviously, you're not expecting to get any money back, no financial return. And obviously, wealth managers can help with how to do that in the most effective or impactful way. I should say at this point that the spectrum doesn't necessarily imply giving up financial return for social return, but there is usually some impact on anticipated return or risk that increases the further right that you move along the spectrum. For philanthropic investors wishing to continue to use their investment assets to primarily generate financial return, integrated investment approaches are incredibly powerful, the ones on the left of that chart. These use environmental, social, and governance analysis to better inform the investment process. These approaches engage with companies that they invest in through the equity and bond markets and vote to improve corporate behaviour. And evidence suggests that these activities, often known as stewardship, actually improves financial returns. Responsible investment takes this environmental, social, and governance research and tilts investments towards best practice. So thematic funds like global climate change, or calculating the carbon footprint of your investment portfolio and aiming to reduce it. These are all examples of responsible investment approaches. Screening is excluding parts of the investment market on ethical or moral grounds. What you're doing is looking to remove things that might conflict with your charitable aims. Impact is where you're looking for a specific social or environmental outcome from your investment. And that might be microfinance funds, for example, aiming to improve access to banking services. So what it is, I think, really useful for you as investors is to consider which of these approaches might be suitable for your organisation. And in doing so, it's best practice to start with the organisation's aims rather than your own views. Obviously, morality and ethics are subjective and can actually be quite divisive in boards. And the strongest foundation for a robust policy is, I believe, to link it to the aims of the philanthropic organisation. So as an example, if you're a health foundation, it would make sense to tilt your investments towards your aims. So that might mean excluding tobacco manufacturers from your global equity portfolio, engaging with any food companies that you invest in about the content of, I don't know, sugar in their breakfast cereals, speaking to alcohol manufacturers about how they market alcohol to young people, researching, promoting the importance of staff well-being, etc. I hope that what you can see is that all of that activity, that is investment activity, are directly linked to back to the aims of the organisation, in this case, improving health. So I said at the beginning that I'd refer back to some research that I did on UK foundations to give you some context. The research is called intentional investing. The reason we called it that was we didn't want to label it responsible investing or ethical investing, because that implied that people who weren't doing it were either irresponsible or unethical. We called it intentional investing because we thought that what was responsible or ethical to one organisation wasn't necessarily the same to the next. And the recommendation of the report, which is on the slide in front of you, was that trustees should try and be intentional when setting their investment policy to support their aims. So thinking about it in the context of their charitable aims. For some, this might mean finance first. For others, there might be opportunities to further their charitable objective in other ways. So our research found that there was a really mixed view of whether adopting these policies to link investment strategies to the organisational philanthropic aims made an impact on returns. 57% thought it made no difference to returns. 18% thought it actually increased returns, whereas a quarter of people that responded to the survey we did thought it actually reduced returns. So what does the evidence tell us? Well, the evidence from historic equity market returns does show that excluding sin would have had a negative impact on returns. Well, and by sin, I mean companies that would have been excluded by religious organisations. But depending on the policy, in the context of a multi-asset portfolio, this negative impact is actually fairly small. Obviously, the larger the exclusion, the greater the potential impact. But if sin pays, thankfully, there's also evidence that virtue can enhance returns. There's quite a lot of academic studies now that have shown that companies with good environmental, social, and governance practices have a lower cost of capital, which makes sense as they're perceived as lower risk. And this does translate into returns for investors. Sustainability or sustainable portfolios have been shown to outperform traditional portfolios. Engagement, which is where investors engage with company management to try and improve behaviours. It is difficult. It takes time to get successes, but when you do get successes, they can be very financially rewarding, as companies are rewarded for becoming lower risk, better environmental, social, and governance policies. So, if that's the academic evidence, if the theory suggests that connecting your philanthropic mission and your investment strategy doesn't need to mean giving up financial returns, what in practice do charities do? So this slide just shows you 4 different behaviours that we found in investors in the UK, in philanthropic investors in the UK, in how they connect their mission with their investments. 76% of investors with a policy were excluding things, removing things that conflicted with their mission. That would include things like excluding fossil fuels, which is this divestment campaign that we're seeing increasingly. 34% of investors were using their policy to actively select investments, so responsible investment policies. 22% of investors were seeking to use their investments to actually influence companies in which they invest through voting or engagement. And just 17% of investors who are using their assets to directly deliver their charitable purpose through sort of impact or social investments. I'm sure we'll hear from Fabrice in a moment on the investment opportunities that have both financial and environmental outcomes as an example. So the majority of responsible investment policies in the UK are about excluding things from the investment universe. And this is the hit list on the next slide. Oh, sorry, we've gone one far. Okay, this is the hit list. So the largest blobs represent the most common exclusions, and you can see the aforementioned sin stocks top the leaderboards, with tobacco, armaments, pornography, gambling, and alcohol being the 5 most common exclusions. And it follows, I suppose, that the type of investors that are most likely to have a responsible investment policy are religious organisations. So that's what the donut charts on this chart show you. 87% of religious organisations in our survey had a policy to connect their mission to their investments. Perhaps because of the common moral foundations, it's easier to apply a common set of principles to an investment portfolio. Conversely, foundations and charities that aim to promote science and technology are the least likely to have a responsible investment policy. I'm sure Fabrice may challenge that notion in a moment. Okay, I wanted to show you some evidence that there is increasing focus on sustainability across the globe. In the UK, we found that the majority of philanthropic investors now have a responsible investment policy, 59%, and that's more than doubled in 5 years. Our global investor study shows a similar picture. This is where we surveyed this year 22,000 investors in 30 countries. This is broad investors, not just philanthropic investors. And we found that 78% of investors felt sustainable investing was now more important than it was 5 years ago, that 64% have increased their sustainable investments over the past years, and that the next generation, in the next generation, 75% of millennials have increased their sustainable investments over the past 5 years. So, you know, it's gaining increasing importance. This matters because environmental, social, and governance factors can have a material impact on corporate performance. It can be on the company's supply chain, direct operations, or in demand for its products and services. So we believe very strongly that analysis of a company's exposure to and management of these factors, these environmental, social and governance factors, in addition to obviously the financial analysis, will enhance our understanding of a company's value, but also of a company's risks. Although this is reaching the mainstream now, we've seen it's increasing in popularity. It's something we've been doing at Schroders for over 20 years. For those of you who don't know Schroders, we're a global investment manager. We've got $577 billion assets under management. And our responsible investment policy is applied to all of our assets. We've got over $40 billion in specific ethically screened approaches. And it's a huge resource, as you can see from the slide. We've got 11 dedicated people who spend all day, every day, doing looking at environmental, social, and governance factors, which means that we can engage with companies globally. 760 engagements in 2016, 34 countries, over 5,000 company meetings voted on. And we have the top ratings and awards to back up our claims and our research. So how do we actually do it? How do we integrate environmental, social and governance factors into the investment decision? Well, they're a 6-stage process. We examine the trends, so that might be looking at climate change or changing labour models or sugar as the next tobacco. We then research the stock exposures, so where equities or the potential investments have exposures to these trends. We analyse how the management deal with these trends and challenges. We evaluate the impact of the management's approach on the investment case. We try and engage with the companies where any concerns may emerge, and then obviously try and track and monitor changes that may influence our conclusions. So it is totally integrated in the decision as to whether or not to invest in a company or not. Some examples of our thematic research. We did some research on sugar and obesity in 2015. That then led to some roundtables with a lot of companies on the issue. And this year we've established some expectations on disclosure, which has been endorsed by over 20 investors globally, representing $2.4 trillion of assets. So you can have a significant impact with that sort of assets. Our climate progress dashboard looks at measuring progress across political, industrial, technology and energy indicators to identify areas that will be most pressure to change in the climate change analysis, which allows us to create better scenario analysis for the companies that we're analysing. And carbon value at risk is the most recent thing that we've published. It's looking in more detail at the carbon exposure to different companies that we're investing in. So just to give you a more tangible example of where environmental, social and governance analysis can add value, our team looked at Volkswagen in 2014 and wrote a report that highlighted concerns about corporate governance. What this meant was that Schroders investors were able to reduce our exposure ahead of what then turned out to be the emissions scandal in September 2015, when we saw 35% wiped off the value of that company in 2 days. So our analysis really did add value to the stock selection process. Another tool that asset managers can use to affect change is engagement. That's where you meet management to try and discuss ESG factors, environmental, social and governance factors, and promote best practice. This is of great strategic importance to us as a business, and you can see that actually we're dramatically increasing our activity. So last year we did over 750 meetings with management to try and promote change. It's about varied topics. It's not just about climate change, but might be about labour standards or transparency and disclosure. Another lever for promoting change is voting at company meetings. You can see again, we report very importantly all the voting activity that we do on behalf of our clients. An example would be the Aiming for A coalition, which has been targeting fossil fuel companies, and this year managed to pass a resolution at ExxonMobil's AGM to increase disclosure on their business plans on how they're going to cope with the UN Paris Climate Change Agreement to limit global temperature rises this century to 2 degrees. Disclosure is at the starting point for embedding change and creating that sort of discussion within a corporate. So we think it's very important. I'm pleased to say that increasingly there are investment products that are catering for responsible and sustainable investors. I've just put on the final slide some examples of products that are offered by Schroders. And obviously do contact me if you'd like any more information on anything that you've heard. But what I want to leave you with is a sense that there are ways for you to invest your philanthropic assets to further your purpose. You can do good as well as generate a financial return. Thank you very much.
Thank you, Kate. I will now hand the time over to Fabrice.
Yes, good morning, everybody, and thank you, Dorothy, for inviting me to the webinar. And as Kate mentioned earlier, I will now speak a bit more how we think science and technology can have a massive environmental impact. So I'll start by telling you a little bit about who we are and what we do. I will then speak about what we call sustainability through innovation, how science and technology basically can have a massive environmental impact, positive environmental impact, and then take you through a few examples of the companies we've invested in and the impact they are having. So if we move to the first slide, so ETF Partners, our name, the acronym ETF, stands for Environmental Technologies Fund. So we are a venture capital fund. We operate in the world of private equity and invest in private companies, high growth companies, very innovative, who are developing products and services that make a positive environmental impact. We were one of the trailblazer in Europe in that sector. We started back in 2005. We have a team of 15 professionals based here in London, and have invested around $250 million over the last 10 years. And the people we work with are a number of financial institutions invest in our funds, institutions that want to allocate capital to sustainable investing. We also work with a number of family offices. Some of them have allocated 100% of their assets to sustainability investing. And we also work with global corporations. And here I show two on this slide. Singapore Power in Singapore, which runs the electricity network, and Asahi Kasei, which is a Japanese conglomerate focused on specialty chemicals. And the reason we work with those corporates is that they are interested in seeing what we see, i.e. working with the companies we invest in, and understanding what are the technology trends in the sector of energy when it comes to Singapore Power, or industrial technologies and new materials when we talk about Asahi Kasei, for instance. So if we move on to the next slide, so what do we mean by sustainability through innovation? So as Kate mentioned earlier, we do think that innovation can address the major environmental problems confronting humanity. So it doesn't mean that as consumers we can do whatever we want. We have to consume, know what we buy, make sure we recycle. We also need governments to be obviously involved and set up the right regulatory framework. But innovation can help us generate clean energy, produce recyclable products, for instance, and so on. And we believe there's a huge need for this. So we talked earlier, Kate mentioned a potential trade-off between impact and profits. In the case of environmental technology investing, there's no trade-off because the need is the opportunity. If you want to a green product to have an impact, it needs to be adopted. It needs to have to make an economic sense. And the companies we are investing in are, are deploying very profitable business models. The third point is we're based in Europe, and we think Europe is a good place to do what we do because there's a very strong alignment between the governments, businesses, and consumers. And so for startups and entrepreneurs, it's a very rich, fruitful environment to operate into. It doesn't mean our businesses are restricted to Europe. And as a matter of fact, we have a number of companies active in Asia, and I mentioned some of our Asian corporate partners. So what we see is a lot of our companies are looking to Asian markets to deploy their technologies. And I will mention a few examples later on. So in conclusion, really, we think that looking at sustainability through the prism of innovation, we can really find very good investment opportunities, opportunities that make a big environmental impact, and at the same time can generate very strong returns. So if we move to the next slide, I just wanted to give you a sense how fast innovation can have an impact on our world when the time is right. And I wanted to go back 100 years ago. What you see on your screen is a picture of the Fifth Avenue in New York. And the red circle points to a car, and that's the one single car on this avenue back in 1900. All the rest are horse carriages. And if we click to the next slide, and you fast forward 10 years or so, the same avenue 10 years later, and here in the red circle, the only thing you can see is a single horse. And the whole avenue is now filled up by cars. So that 10 years, that's the very short time, if you think about it, to move from horses to cars. But it did happen. So if we move to the next slide, and we talk about today, and if you think about the news you heard about in the newspaper last summer, in the UK, the government talked about the end of diesel and petrol car. The French government also made an announcement. China is thinking about a ban of diesel and petrol car. So you can see how we are very fast moving from a world of kind of dirty diesel cars to autonomous electric cars. And it might be that within 10 years, we will have completely shifted with a huge positive impact on the air quality in our cities, on the use of land in our cities, and the way we move in our cities. So that was just an example of how fast things can change through innovation. So if we move to the next slide, I'll give you 3 examples of what we do in 3 different sectors. The 3 sectors we focus on are what we call smart cities, the second one, smart industry, and the third one, smart energy. So we like smart things. So if we move to the next slide and start with smart cities. So clearly cities today are facing big environmental challenges it's like all the problems of the world are concentrated in our cities. Air pollution, traffic jams, energy requirements, waste recycling, and so on. And so what we are looking for is companies that can help our cities be smarter, very often leveraging information technology, connecting assets, moving people in a smarter way. And I'll give you one specific example because it's always more fun to talk about a specific company. So if we move to the next slide, I will talk about a company called Vulog. And this company is deploying car sharing technologies. So what is car sharing? Car sharing, you basically have cars that are parked in the street and that you can rent per the minute or per the hour through your smartphone. And Vulog is one of the leaders in deploying this technology and works with operators around the world. So I show here some examples. You know, in Vancouver, they're running more than 1,000 cars in car sharing in the city. You have examples in South America, in Sao Paulo, Madrid, Copenhagen, New Zealand. So it's really something that's growing across the world. They're actually looking at their first projects in China in early next year. And it's changing the way people use cars and travel within cities. So if we move to the next slide, I'll tell you a bit about how we think about the impact this company can have. It's a bit of a busy slide, but if you focus on the upper left corner box on that slide, we talk about our impact targets. And clearly one of our targets, as I mentioned, is to enable the sustainable city. And within that, we're trying to find solutions to reduce the emissions of vehicles and increase the quality of the air. So if we think about Vulog as a specific investment, there are a few very interesting statistics to look at. The first one actually is that when you share one car, you take 10 cars off the road. So that means if we were all moving to car sharing in big city centers, we could divide the number of cars by the factor of 10. And just that has a massive impact. The second point is that most of the cars that are operated in car sharing mode are actually electric cars. So second massive impact. And the third one is very often the statistics we have is when a car is shared, it's very likely that you have more than one passenger on that car. So this company is really having a massive impact, and through our investments, you get quite a big bang for the buck, I would say, by enabling the deployment of car sharing in all the cities I've mentioned earlier. So that was the first example in the sector of smart cities. If we move to the next slide, I'll give you another example in a sector we call smart industry. So what we define as smart industry is, you know, how do we become smarter about the way we make things? How do we are smarter about recycling materials, about better using our existing infrastructures, and so on. So we've made a number of investments in that space. Some people examples can go from 3D printing to new water technologies. But if we move to the next slide, I will give you an example that I really like, and it's actually an investment we've made with a family office in Hong Kong. The company is called eLeather. It's a UK business, and what they do is that they recycle waste leather, and they have a very innovative process to use that waste leather, shred it, and recreate a new leather from that waste material. A new leather that's actually better than leather itself, than natural leather. And I give you two examples here on that slide. On the right-hand side, you have a picture of a Delta Airline aircraft cabin. So if you fly Delta today or American Airlines, I think some of the Singapore Airlines planes have started to use e-leather on their seats. And the reason they love it is that it's not only it's more durable than natural leather, but it's also lighter. And in an aircraft, weight counts, and they can save a lot of fuel using that material in the cabin. The other example I give on the left-hand side is Nike. We announced just a month ago a breakthrough deal with Nike, and Nike is going to start using e-leather for all their leather shoes, which is great to have the endorsement of such a big brand, and we believe this will have a big impact. Actually, when we talked to Nike, what they told us is that leather is the most polluting material in their supply chain. And the statistic they gave us is this: when they buy 1 kilo of leather, only half of it end up in the end product. So if you can recycle the other half, you're having a huge impact. And that's why they love this product. So if we move to the next slide and we put it in the context of our objectives at ETF, again, if you look at the upper left box, I talk about our targets. Clearly, recycling is one of them, and we're also looking at more advanced manufacturing processes. And really, e-leather aligns with those two targets. I mentioned how Nike believe that e-leather is making their supply chain more sustainable, and I mentioned some of the airlines as well that are saving tons of fuels every year using that product. So the last example I will give you is in the world of energy. So if we move to the next slide, we talk about smart energy, digital energy. You've all heard about the transition to renewable energy, and actually Asia is a fantastic market. China, India, and other countries are deploying massive renewable energy capacity. This is creating new challenges as those sources of energy are intermittent, and the way we use energy is also changing. And so we focus very much on what we call digital energies, new ways to distribute and use energy and connect energy with the consumers. So if we move to the next slide, I will give you one example again. A company called, it's a software business actually, it's called CES Energy. And if you think about the last 10 to 20 years, people have been focused on building new energy assets. So the focus has been on capital expenditure and making sure that the windmills and solar panels were as cheap as possible to make energy competitive. Today now, the focus is very much on reducing the operational expenses of those assets as the market is becoming more competitive. And very simply, one of the tools renewable energy operators are using is information technology and software. And COS has developed this platform on which you can connect all your assets and make sure that they operate at the best level, and that you can optimize the maintenance on those assets and basically deliver the cheapest renewable energy possible. So clearly, again, today I think there are more than 5 gigawatts of energy managed by this platform. So it is having a big impact. So if we move to the next slide, for this last example, again, I talk about our targets, impact targets, and one is to enable the deployment of renewable energy. And clearly, with that investment, we are helping operators to make sure they deliver the cheapest green energy to the grid. So next slide, just to maybe wrap this up a little bit. We're actually very proud of the impact our portfolio companies are having, and I hope that through those examples have demonstrated how investing in technology can have a huge environmental impact. And this is really the essence of what we do. We think that the next 10 years actually things will only accelerate. I talked about cars becoming electric and autonomous. I think our energy system is rapidly moving to a very smart and clean energy grid. And also with e-leather, I've shown that some of the most the products we love, but that are sometimes not so green, like leather, are becoming greener. So I'll conclude with one last quote from Victor Hugo that basically summarizes this. The idea that it's on the next slide. The idea that when the time is right, a great idea can have a massive impact. So thank you very much, and I'm looking forward to your questions.
Thank you, Fabrice. And now we will move to the question and answer, and we have received quite a few questions. The first one is for Kate. Does Schroeder regard impact companies as a separate asset class? If so, does Schroeder expect a lower financial ROI from such companies?
Hi there. Thanks. It's a really good question. I think we view it as a spectrum. There are, depending on the type of impact and the type of companies that we're looking at, or the category, we'd either classify them separately, where charities or foundations or other investors are seeking something more than just financial returns, and where we have that in terms of the asset class returns and risk forecasts, they would be viewed separately in terms of overall asset allocation. It's not always the case that it is lower return, as I said in my presentation, but it is often the case that there are additional risk factors that may be important to consider, whether that's liquidity, because often these opportunities are relatively illiquid, more like venture than mainstream sort of open market opportunities. So that would mean that we treat them slightly different in a multi-asset portfolio to a more mainstream impact fund. I mean, the impact label is being used in so many different ways across the market, but a fund that is targeting a impact by investing in mainstream markets. In that scenario, we would include them within our normal asset class definitions and therefore our normal asset class return and risk forecasts.
Okay, thank you, Kate. But this is a general question. Why would philanthropy charitable contributions still be in currency in an era when you have impact funds giving the added edge of financial returns? Fabrice, would you like to take that question?
Yeah, no, I can certainly talk a little bit about it. I think when we talk about, for instance, what we do investing in environmental technologies, we're still on the early days of the shift towards that kind of investing. And so I think every dollar, pound, euro invested into those strategies is having a big impact to convince bigger pension funds, bigger asset managers to then follow on. So the reason we could get started 10 years ago is because we had very strong believers behind us, and that included family offices that have being a huge supporter of ETF. And very often, you know, they would invest maybe checks that much smaller than bigger institution, but they would be the catalyst to the launch of our fund. So I think philanthropy still can have a huge impact, even when it comes to profitable investment strategy by helping seeding new funds, new teams, and convincing the bigger asset managers that they should also allocate some of their money to that.
Absolutely. I think I would agree that we're still fairly early on in the development of a market, and that's probably a limiting factor for larger investment managers such as ourselves, you know, where we value sustainable and impact investing, but it's difficult to allocate capital to it in a way that is liquid and that sort of falls part of mainstream markets. So I think there is a big role for philanthropic investors to play in building the market and demonstrating that this is an opportunity for investors to generate not just a good financial return or an acceptable financial return, but actually to have positive impact as well.
Okay, thank you. This question is for Fabrice. To what extent does ETF require the international adoption of the impact technology by its investee company?
Sorry, the adoption of, I missed that.
Let me repeat the question. To what extent does ETF require the international adoption of the impact technology by its investee company?
I don't know what is meant by impact technology. Our companies are developing positively impactful technologies. Maybe it meant our companies also following best practices when it comes to ESG. What I can tell you is when we invest, first we make sure that the products and services that are being developed by those companies have a positive environmental impact. And it might seem obvious, but sometimes, you know, when you're talking about IT or materials, you really have to make a proper analysis. When it comes to the way our companies are run, we also make sure clearly they implement best practice in terms of governance. And as a matter of fact, we got a few awards on that front, and this year we were selected by the British Venture Capital Association as one of the leading sustainable investing funds.
Thank you, Fabrice. Okay, this is a general question. One of the main reasons responsible investing has not broken through to the mainstream is because most businesses have struggled with how to measure and track the impact of their sustainability activities on core business metrics. How do Schroders and ETF measure and track?
I take that? That's a really good, very insightful question, because it's really difficult to track both from a corporate level, i.e. When we're looking at companies that we invest in, but also from our own impact as an investor, how effective we are. Obviously, it's very specific to the industry that the company works in. So if we're talking about a food company, the metrics that we would use in terms of tracking their impact would be different to the metrics we'd be using on a energy producer, for example. So I think it is very context dependent, and certainly our view is that we need to be very, we rely on our own research, and therefore we need to commit a lot of research time into those sort of impact assessments. On a sort of more macro view, is how do we track our own performance as responsible investors? Well, we use quite a lot of data. So what we're obviously tracking is the number of engagements, for example, that we do each year, but not just the number of engagements that we're doing, but obviously our success rate on those engagements and how long it's taking us to deliver the change that we want to achieve. And then once that change has been delivered, how that has translated into financial performance, both in terms of corporate performance and market performance as well. So I think there's sort of multi-layers of how we can appraise our own performance. And then there's the broader things like, how we affect change in terms of policy with our discussions with governments and regulators, and starting to try and develop products like we're talking about today, sustainable products, making them more mainstream, which is part of our role as a large asset manager. So I think that it's multi-layered, and what we're trying to do, and you can see if you go onto the Schroders website, is we do report quite a lot and put a lot of emphasis on our sustainability franchise in order to try and apply influence, but also report on the impact that we're having.
Thanks, Kate. Fabrice, do you have any thoughts?
What I would say is for us, the companies we invest in are small businesses in a way. It's 50 to 100 people. So it's not about looking at the environmental footprint of the existing organization. It's really looking at the positive potential impact of the products they are developing. So when we got started, we realized there was no framework around available to do so. And we as I mentioned earlier, we basically have, each time we look at a business, think about the impact the products they are and technologies they are developing can have. And if I go back to Vlog, the car sharing company, if one car shared can take 10 cars off the road, that means I can remove by a factor, I can reduce the number of cars in London by a factor of 10. That's a massive impact. So that's the way we go about it.
Okay, thank you. I think we have time for a couple more. This one is for ETF. How do you identify, incorporate, and manage negative externalities of the projects you invest in?
So it's a very good question, and it comes back to how to make sure that what we do has a positive impact, because some technologies can be double-edged. So if you go back to the example of the car I took back in 1900, one pollution issue in big cities at the time where there were too many horses, and that created problems. And so cars were seen as much cleaner. But 100 years down the road, emissions have become the issue. So there's no straightforward answer, and it goes back to case-by-case analysis of the products and services we look into. And another example today is, if you think about the electric car, there are some unknowns around the impact of the supply chain required to produce batteries and recycle them. But on balance, we still feel today it's a positive innovation.
Okay, thank you, Fabrice. We are coming to an end of the seminar. Before we end, do you have any further advice for Asia?
Shall I take that? I suppose my advice, I don't know if it's for Asia as a whole, but for philanthropic organisations or people interested in this, is that we should all work together. I think collaboration is incredibly powerful, and whether that's collaboration as investment manager, investor, venture capital, promoting change within companies, I think that collaboration, certainly in this sphere, can show real results, and that's how we build a market, and that's how we continue to develop very exciting new technologies to solve global problems.
Excellent.
Yeah, I mean, I clearly totally agree, and as I mentioned, we actually working already with Asian family offices and leading corporations, and so it's a very fruitful partnership already in our case, as we can find larger markets for the innovations we can invest in, and in the end having a greater environmental impact.
Thank you very much, Kate and Fabrice. And thank you everyone for your participation in this interesting session. We will be forwarding your questions to the speakers, and we will also post the webinar recording on our website by next week. Please look out for it and see you at the next AVPN webinar. Have a good day, everyone.
Thank you.